What's going on, ladies and gents? 1 second. There we go. All right, friends, welcome aboard to tonight's special webinar. We're going to be talking about earnings reports. How do we trade an earnings announcement? What is an earnings announcement? How do you analyze a stock into an earnings announcement? How do you understand what market expectations are, what the market's pricing in? All sorts of fun stuff around earnings announcements. Okay, so we are getting into the thick of earnings season here. We had Microsoft report earnings recently, got some heavy hitters coming out in the next couple of days. So I want to give you the tools that you need, the information that you need to be able to analyze what does the market expect going into earnings, what is the market pricing in going into earnings, and if I want to make a bet into earnings, if I want to make a trade around an earnings announcement, how do I do that? Okay, how do I do that? So that's the name of the game for tonight. I'm going to take some notes. I've got my chat window up here so I can see everybody on YouTube hanging out with us. Welcome aboard. Ahmad, Adib, Guitar Flip, Dennis, Michael, hello. Let me grab a Word doc here and we'll set the table and be ready to rock. Okay, how to trade earnings reports. This is YouTube 10/28/2020. All right. So first things first, I want to bring you all up to speed here on the earnings season. So if you've never really paid attention before, if you're brand new, I'm going to help bridge the gap and bring you up to speed. Okay. So what is earnings season? What is earnings season? This happens 4 times a year. Use the calendar. Make your life easy. January, February, March is the first quarter. Just noticed I'm still logged in as Noah. I can kind of be Noah. Let me switch my name here real quick. Come on. Come here, Zoom. Where are you? There you are. All right, much better. Okay, use the calendar. Jan, Feb, March is the first quarter of the year. End of March, companies, assuming they're going with the calendar quarter, some of them don't. Some of their earnings follow a little different schedule that's not on the January to December, cycle. But most of them are. So Jan through March, first quarter. So April, you're going to have a lot of earnings for Q1, right? Q1 earnings. April, May, June is the second quarter of the year. So July, you're going to get a bunch of earnings for the second quarter of the year. End of June, close the books. Take a week or two, get the numbers together, get them ready to release to the shareholders sometime in mid-July. Then you have July, August, September, the third quarter of the year. So October, you're going to report Q3 earnings. And then, of course, October, November, December, the fourth quarter of the year, you're going to report those in January. So come January, you're going to get Q4 earnings reported. That's the general schedule. So here we find ourselves in October. Okay, and we're actually almost done with October, right? We're 4 weeks into October. So we've already had some companies report earnings, but there's a lot of them this week, right? A lot of them have been reporting this week. That's when you're going to see earnings announcements cluster. If you are a trader and you don't like trading into earnings, you probably aren't going to like trading these 4 months. It's challenging when you want to place a trade, but the company has earnings in the next 2 weeks or the next 1 week or something. So sometimes trading individual stocks, a week into October, 2 weeks into October can get a little tricky because you got that earnings announcement coming up. Okay. So What do we need to know about earnings reports? Just general kind of principles here. Number one, the company is going to report two big numbers. Revenue, this is the top line, revenue or sales, okay? And then the bottom line, which is earnings. And that's usually expressed as earnings per share, EPS, earnings per share. And there's usually forecasts going into the report as to how much money these companies are going to make. And then depending on if they smash the numbers and exceed expectations, or fail to meet expectations, that can have some big impact on the stock price. And so you want to treat these events, bottom line, these are binary events in terms of the stock price reaction. So it's a 50-50 proposition. It's a coin flip. The company might go up after earnings, it might go down after earnings. It really is a 50-50 proposition. Okay. So here's a bad idea. Buy a stock right before the announcement and sell it the next morning. Because usually earnings announcements come out after hours, after the market closes. Okay. So buy the stock right before the bell, the closing bell, hold it overnight, and then sell it the next morning. That would be a pure play on the earnings announcement. Your trade outcome is going to be 100% based off of, does it gap up after earnings or does it gap down? You want to make a pure bet into earnings, that's what you do. 1 second before the bell rings, buy the stock, hold it overnight, and then in the next morning at the open, sell the stock. And you would capture perfectly the reaction to the earnings announcement. Why is that a bad idea? Because you have no idea what's going to happen, right? What we want to do as a trader, if I'm thinking in terms of being a short-term trader, we're trying to put ourselves in situations where we have a high probability of profit and we have a low risk, high reward setup, right? Where if I'm wrong, I lose a little. If I'm right, I make a lot. I don't know about you, but an earnings announcement where it's a 50-50 outcome, a coin flip, I really don't have an edge. Okay. So making directional bets right before earnings have no edge. As a result, they are not attractive. That is why, in general, traders don't like to buy or sell stocks right ahead of earnings. Maybe sell them, but sell them short. Okay, they don't want to shorten or go long right before earnings. Just over time, you're right sometimes, you're wrong other times. Really is kind of a 50-50 deal. Okay, not a good idea. Now, where it gets interesting, however, instead of making a directional bet where I have no edge, what if I made a volatility-based bet? So instead of saying a directional bet would answer the question, which way, up or down? Okay, that's a directional bet. Those are hard into earnings. You have no edge. You're going to win some, you're going to lose some. It's really hard to build a system and have confidence in it if it consists of, oh, all I do is just guess when Apple's going to go up after earnings or guess when Google's going to go down after earnings. That's my game. Yeah, good luck making money that way. Well, instead, what we can do is we can make more of a volatility-based bet. If a directional bet answers the question up or down, which way, a volatility bet would answer the question how far or how fast. Those are volatility type questions. We can make trades that profit based on how much the stock moves, not if it goes up or down, but if it moves more than expected or less than expected. So bet one would be a short volatility bet, meaning I'm going to bet I win if we move less than expected. Okay. Or you could go the other way if you're going to make a volatility bet. You could do a long volatility bet where you win if we move more than expected. You win if we move more than expected. Okay, does everybody understand the difference between a directional bet and a volatility bet? Directional bet is up or down. Volatility bet doesn't care which direction. Rather, it cares how far we move or how fast we move. So a volatility bet is all about magnitude, not direction. Magnitude, not direction. What's interesting is I don't like making directional bets into earnings. I do like volatility-based bets. So if I am going to trade into earnings, I'm going to make some type of bet around how much the stock's going to move. So we much prefer volatility based bets over directional into earnings. Okay. I think you're going to have more luck with that. I think you're going to have more success with that. I think you have more of an edge. Okay. We can create trades with more of an edge. Okay. Now, one second. I got some hoodlums upstairs and I need to text my wife here. All right. So how do I make a volatility-based bet? Well, I gave you some general principles. Now, here's general principles part 2. General principles part 2. My intent for tonight's discussion is to take you from A to Z, from A to Z. I want you to understand earnings very, very well by the time we're done. Okay. And so we should progress, chronologically to really understand how to analyze and size up an earnings announcement and how to bet into earnings if you so choose. That's the goal. Okay. So volatility principles. Got my general principles. Now let me comment on volatility for a second. Okay. Number 1, everyone knows stocks are volatile around earnings. They gap up or down. Okay. So what you have to look at is what is baked in. What is baked in? What is the market baking in? What are the market expectations? What are the expectations? Okay. That is known as the quote expected move or the market maker move, which is sometimes MMM. Okay. Expected move or market maker move. Okay. So if I'm going to place a trade around earnings, for me to make an educated decision, I have to know how much movement is expected. Is Apple expected to jump $10? Is Apple expected to jump $5 or $20? I can't really build the trade unless I know what's baked in. Okay. Because the question is going to become, how do you feel about the expectation? What do you think? Do you think Apple's going to move $10? Do you want to bet that it's going to move more than that? Do you want to bet that it's going to move less than that? See, I don't have an opinion until I know what's priced in. I don't have an opinion until I know what's priced in. So how do we find this? How do we find this? Well, luckily, Thinkorswim makes it pretty easy. Okay, Thinkorswim makes it pretty easy. So let's take a look at Apple, which reports tomorrow after the bell. Apple reports tomorrow after the bell. Okay, Thursday night. Who else reports tomorrow? Google. Google reports tomorrow after the bell. Okay, I know Microsoft already reported, but let's use Apple. Okay, let's use Apple. So Apple is trading for $111.20. $111.20. Okay. If I go to the trade tab There are two ways you can find this. A couple ways you can find this. Number one, you can, in the trade tab, oftentimes you will see on the top right this MMM, market maker move, $4.04. That is the earnings move that is priced in. Option traders, the collective wisdom of everybody who's putting money into the market, has, through supply and demand, pushed the prices of options to a level where Apple would have to gap up or down $4 to justify. So if we got a $4 move up or a $4 move down, that is the expected move, the expected range that Apple will trade in, essentially between Thursday night or Thursday and Friday. Okay, Thursday and Friday. That's the expected move. So for Apple, we're gonna do a little bit of math here. Okay, for Apple, it's at $111, and the MMM is $4, and I'm going to round 5 cents. Now, I can convert that to a percentage. Okay, I'm going to make you do some math here. If Apple were to move $4.05 as an $111 stock, it's about a 3.6% move. Okay, 3.6%, and that's up or down. That's what the plus minus means. That could be up or that could be down. So are they baking in a lot of movement in Apple? Is Apple expected to have fireworks, positive or negative? No, not at all. 3.6%, not much movement. Heck, how much did Apple move today? Apple moved 4.6% just today. Did it have an earnings announcement? No. The broad market sold off, and they smacked Apple 4.6%. Apple is expected to be less volatile over its earnings announcement than what you saw today. Okay. So is that pricing in a ton of excitement? No, not really. Now, admittedly, today was a pretty big candle, but all I'm saying is you take today's candlestick, that's essentially what they're baking in, actually less than that. We moved $5.40 today. They're baking in less than today's candlestick for Apple's earnings. That is the expectation. Okay. Now, what if I can't, what if the market maker move is not displayed? What if the market maker move is not displayed? What if I go to the trade tab and for whatever reason, it doesn't show me the expected move up there? There's another place you can look at to see it. Okay. You can look at this option chain on the right-hand side, whatever's the shortest term duration. So this has 2 days to go, and it's saying that there is a $6.21 move being priced in between now and expiration, which is 2 days from now. This is a weekly option that expires at the end of the day on Friday. So they're pricing in a $6.22 move between right now and Friday, end of day. Do you notice how the market maker move is less than the range expected between now and the end of the week? Well, that makes sense because the market maker move is trying to isolate the overnight gap from Thursday to Friday. This $6.21 includes Thursday's trading session, overnight to Friday, where the gap will be on earnings, and Friday's trading session. So if we talk about just the overnight gap versus the day before, the day after the earnings gap, obviously you're going to have more movement because there's more time if you're taking into account the day before and the day after. And so the weekly option expected move should be larger than just the gap that's expected on earnings. But if it didn't give you the market maker move, like if this $4 wasn't here, we could extrapolate what the expectation is just by looking at the expected move between now and the end of the week, $6.22. Okay. Now, the reason why you want to look at the expected move for the front month or the front week in this case is because that's going to more purely capture the expectation of earnings. You could look at the expected move for the Jan 2022 option if you wanted to. Apple's expected to move up or down $45 in the next year and a half. But that's not really what I'm trying to do here. I want to see what's the expectation like right now for the next day or two, because earnings is imminent. And so the front week option is going to be the purest picture or illustration or depiction of what's expected for the next day or two. Okay? So that is how you identify what is the status quo, what is baked in, what is forecasted based on the current market conditions. Why does that matter? Well, because it helps you shape your expectations. Okay. Couple of interesting things here. So we've got the expected market maker move. So if the market maker move is not displayed, then look at the expected move of the front month or week options. Okay. And so for Apple, that was $6.22. Now, what's my next volatility principle? Well, the market is really good at forecasting how much a stock will move. Okay. Now, what's going on, Emily? Good to see you. If you'll allow me, I'm going to go a little more advanced today. I'm going to go a little more advanced on these numbers. I'm going to try not to beat you over the head with statistics, but I just want you to kind of get an idea of how often we should expect the stock to move as much as is priced in. Okay. And so generally about 2/3 of the time, the stock moves as much or less than expected. Okay. About 2/3 of the time, Apple will gap as much or less than expected. So if we looked at 100 earnings announcements, how often would Apple move this $4.05 or less? Answer, 2/3 of the time, probably 66 out of 100 times, Apple would move within that plus or minus $4. Okay, not 100% of the time, about 2/3 of the time. It's a one standard deviation, okay, which is roughly 2/3. So that $4 is a one standard deviation move, a 1 sigma move, in other words. And then 1/3 of the time, about 1/3 of the time, the stock moves more than expected. So if you asked me, Tyler, am I usually going to win if I bet that a stock's going to gap more than expected on earnings? Is that a high probability bet? Betting that tomorrow Apple's going to move $8 or $10 or $20? What would my answer be? My answer would be no. That is not a high probability bet. That is a low probability bet. Most of the time, Apple will move as much or less than the options have priced in. Okay. So if you want to go with the odds, if you want to place a trade, a volatility-based trade around earnings, you'd probably rather bet that Apple's going to move less than expected. How do you do that? Well, I'll get to that in a second, but that would be a bet where the odds are in your favor, meaning most of the time you win. Okay. So gun to the head, is Apple going to move more or less than $4 on earnings? I would say less than. It'll move $4 or less. Okay. Now, you see, this is where you can develop an opinion. You may say, you know what, Tyler, I don't know, $4, it's not pricing in that much. I'd actually rather bet it's going to move more than that. Well, that's fine. That's how you develop an opinion, right? So when it comes to, how do I pick which volatility bet to make? One of the answers could be how much is priced in. Do you have a strong opinion on that? Do you think it's right? Do you think it's right? If you think that it's going to gap, if you think, man, $4, this thing just moved $5.50 today. I kind of want to bet that Apple might move more than expected.
Can you finish?
Well, then do it, right? Then do it. By the way, I don't know if you saw the little army man crawling in here. This is my boy. Webcam's on, so if you come in, you gotta say hi to everybody.
No.
Okay, then bounce.
No, Dad, are you gonna be done soon?
I'm gonna be done in 35 minutes. Wasn't very sneaky of him, huh? All right. Apologies. Okay, so if you have a strong opinion as to how much the stock's going to move, that might influence which strategy you select. It's going to influence which strategy you select. Okay. So yeah, Ahmad, you finally spotted one of them. That was my oldest. His name is Sawyer. Okay. All right. So if I have an opinion on how much the stock's going to move, that's going to influence which strategy I pick. Okay. What's the next thing? Well, let's get into which strategy I might want to pick. Okay. What are these volatility-based strategies? Okay. So earnings-based strategies or volatility-based strategies, you could use those two terms interchangeably. Okay. You could use those interchangeably. So if I want to go long volatility, if I want to bet that the stock will move more than expected, how would I do that? Well, you could do a long straddle or a long strangle. Long straddle or long strangle. You could do an inverted butterfly or a debit condor, which we like to call a debicon. Those are probably the four most common ways of betting that a stock's going to move more than expected. It's a long volatility trade. If you think Apple will move more than $4, okay, maybe you think it's going to move 5, 6, 7, 8, 9, 10, whatever in the next couple of days, you might want to do a long volatility trade. You might want to buy a straddle or a strangle or an inverted fly or a condor. Okay, now you may say, well, Tyler, I've never done any of those strategies. Well, look, I've only got an hour. I can't teach you every strategy that I just mentioned, but those are the ones that fit in the box called long volatility. Those are the strategies where you are inherently betting the stock's going to move more than expected. On the flip side, you could do a short volatility trade. You could bet that the stock will move less than expected. Bet that the stock's going to move less than expected. Now, let me pause on that for a second. I want to make something very clear because this is a common misconception. Okay, common misconception. People think that because a stock gaps on earnings, that buying a straddle is a great play. Oh, Apple's going to move a lot on earnings, up or down, I don't know. Let's do a bi-directional trade. By the way, these are also known as bi-directional trades. Okay, well, you can, but it's not a matter of will the stock move a lot on earnings. Yes, it will. Everybody knows that. Okay, everybody knows Apple's going to move on earnings. Microsoft's going to move on earnings. Any stock moves on earnings. It's not a matter of will it move a lot. We know that. The question is, will it move more than expected? Will it move less than expected? That's the question. The fact that it's going to move is a given. No crap. The election, okay? The election's coming out next week. Is that going to cause the market to be volatile? Probably. Is the market going to move a lot? Probably. Should I buy a straddle? I don't know. What's priced in? Do you think it's going to move more or less than that? Okay. So this is not, you can't just say, oh, market's going to move by a straddle. Nope, that's an oversimplification. And it's probably, you're probably leading somebody astray. Instead, you want to say, what is priced in? What's the market maker move? What is the straddle baking in? What is the expected move based on option prices? That's your baseline. That's your baseline. Then the question is, do you think we're going to move more than that? Do you think we're going to move less than that? That's the question. But you can't really form an opinion until you know what's priced in. I mean, look, like if you look at the election, for example, because all of these principles I'm teaching you around earnings could apply to the election or any economic event that is looming that could impact the whole market. When you look at what's priced in, that's reflected so far. I've taken the angle of market maker move, look at the option chain. That'll tell you what's priced in. But the other way that you could illustrate or teach that is you could say, well, implied volatility tells you what's priced in. If you look at a chart of implied volatility, that gives you a sense of the expected move. The VIX is the implied volatility index for S&P 500 options. The VIX jumped to 40 today. And if you look long term, it is not common to see the VIX this high. It is not common to see the VIX up at 40. Okay. It doesn't look that high because March blew this out of the water when the world was ending and the VIX went to 85. That was a massive outlier. If that wasn't on the chart, this spike to 40 would seem much more dramatic. But if you look at the last 10 years, it's rare to get the VIX up at 40. There's a lot of uncertainty being priced in. Okay, they're baking in a lot of movement around the election. Should you buy a straddle? I don't think so. I mean, they're pricing in a lot of movement. So for you to make money, we got to move even more than this big movement that's priced in. So just keep that in mind. Okay, keep that in mind that things are already priced in, and the question is, you think we'll move more or less than that? Okay, what if I think back to Apple? What if I say, let's go with the odds. Most of the time, the stock moves less than expected. They're expecting Apple to move $4. I'm thinking it'll move 4 or less. I'm thinking it'll move 4 or less. So yeah, let's go with what usually happens. Let's bet the stock's going to move, less than expected or as much as expected by shorting volatility. How do you quote unquote short volatility? Well, you sell options. And if you want to do it in a way where you're not making a directional bet, it's got to be a delta neutral type of strategy, okay, where the directional exposure is negated and it's more just a pure play on volatility. And so it is the inverse, it is the opposite of the 4 strategies I just told you get you long volatility. Remember, there are 2 parties to every transaction. For every buyer, there is a seller. If the buyer wants the stock to move a lot, then the seller doesn't want the stock to move a lot. If the buyer of a strategy wants the market to go crazy, the seller of that strategy wants the market to go to sleep. They are on opposite sides of the transaction. Think of it as a zero-sum game. Whatever's good for this guy is bad for this guy. That is how you want to think about these. What is the opposite of a long straddle? A short straddle. That is a short volatility trade. What is the opposite of a long strangle? A short strangle. What is the opposite of an inverted butterfly? Just a regular butterfly, a non-inverted butterfly. What is the opposite of a debit condor? A regular condor. Okay, usually we do an iron condor. So those would be the four most common delta neutral short volatility strategies. Okay, do I have time to teach you 8 different strategies from A to Z? No. Become a pro member at Tackle Trading, go to the Tackle Trading playbook, and you'll see tons of information on each one of these strategies. I'm going to give you a taste tonight. Okay, setting the table, making this nice and easy to follow, hopefully. But in the box that says short volatility strategies, those are the 4 most popular. Okay, so if you want to bet that Apple's not going to move that much on earnings, the way you would do so is you would sell a straddle on Apple, you would sell a strangle on Apple, you would do a butterfly or a condor. Those are the 4 core ways of getting short volatility. Now, do I feel like Apple is going to move less than $4? They're not really pricing in that much movement in Apple right now. I don't know that I have a strong opinion, quite frankly. I don't know that I have a strong opinion on Apple going into earnings as to whether we should bet it's going to move more or less than expected. They're really not pricing in that much. So your margin of error, if you were doing a pure kind of short volatility play into earnings using super short-term options, not a lot of margin of error. Okay, I don't know that I'm in love with shorting volatility into Apple earnings myself. I certainly wouldn't do it with a 2-day option. Okay, if you really want to be gutsy and go short volatility on Apple and bet it's not going to move much, you use a 2-day option. It's a pure play on the move. You'll either make money really quick or you'll lose money really quick. Okay. So it's a high risk, high reward proposition. But in terms of which one of the strategies you use, let's just say this. For the short volatility, the short straddle, short strangle, these are the riskier strategies. And the butterfly and the condor would be the safer strategies. Okay. Long straddle, long strangle, if you want to go bi-directional, bet we're going to move up or down a lot, those are the more expensive trades. And then the long volatility B, these are going to be the cheaper trades, the cheaper ways of getting long volatility. So that might be one way you can kind of differentiate between these. I rarely go long volatility. In fact, I can't remember the last time I did a long volatility trade. I'm almost always shorting volatility myself. And the one that I use the most often would be the iron condor. Okay, so now that's just me. You do whatever the heck you want. But if you're curious, that's, I think, the one that most people are going to be using when they want to sell volatility. Okay, so let's suppose, to advance the discussion here, suppose we want to short. Actually, in the case of Apple, I don't even mind doing a long volatility play. Let's suppose we think the $4 move in Apple is easy to beat, meaning it's easy to move more than that. Okay, easy to move more than that. So we actually want to go long volatility. Which strategy would I consider? Probably, I like the inverse of my favorite short volatility trade. So if iron condor is my favorite short vol, then maybe my favorite long vol is the debit condor. Okay, partly because it's cheaper, it's less risky than buying a straddle or a string. Okay, and so really, if we had time, I would do a whole hour-long discussion on a debit condor. But fundamentally, what you're going to do with a debit condor is you buy an out-of-the-money bull call spread, hoping that the stock will go up through the spread, and you buy an out-of-the-money bear put spread, hoping that the stock will go down through the spread. So either we want to go up and win on the bull call, or we want to go down and win on the bear put. Because I did a bull trade and a bear trade at the same time, that's what makes it bi-directional. Okay. Now, if you don't know what a bull call or bear put spread is, well, good. That's a thread that you can continue to tug on. That's some homework for you, is to go learn that strategy. Again, if you join us here at Tackle Trading, if you become a pro member, we have all sorts of videos that show you how those strategies work. Okay, so come take us for a test drive. Hard to teach you everything in 45 minutes. Which month do I use? Well, it depends. If you go short term, like, a 2-week option, that's going to be more aggressive. So you win quicker if you're right, but you lose quicker if you're wrong. Okay. If you go out longer term, like a 2-month trade, that's more conservative, where you'll make money quicker if you're right. You will lose, let's say it this way, win slower or lose slower. Okay. So it just moves slower. Okay. It just moves slower. But let's build this. I'm just curious. I'm going to go out like 1 month. I'll go to the November monthly option. Okay. And I'm going to buy the stock's at 111. Let me buy like a 30 delta put. And I'm going to buy that. And then I'm going to sell the 20 delta with just a $5 spread. Okay. So I'm going to buy a $5 wide bear put, a 105-100 bear put spread for $1.40. Okay. And then what I'm going to do is I'm going to go kind of equidistant or similar delta on the other side. That would make it delta neutral. So basically, if I bought a 30 delta put and sold a 20 delta put, I got about a 10 net delta on that. So I would just need a 10 net delta on the bull call to make it perfectly balanced. Okay. And I want to try to go somewhat similar in terms of the strike that I buy. So I bought a 30 delta put. So I want to round a 30 delta call. Okay. So let's go with a 120, 125 bull call. 120, 125 bull call. Okay. Now, I'm not perfectly equidistant. I'm actually $5 out of the money on the put side, and I'm $10 out of the money on the call side, but my deltas are balanced. So you kind of have to decide, do you want to go equidistant both ways, or do you want to have it delta neutral? In this case, I basically just set it up where it's got to go up more than it goes down to get to my profit on the bull side. But this is what the trade looks like. Okay, this is a bi-directional inverted condor, or you could call it a debit condor. So I need Apple to get down below 100, or to get up above 125, or to get up above 125. Okay. That would be ideal. So this is a bet that we're going to move more than expected. Okay. If you look at what's baked in forget earnings for a second. Let's just say between now and November expiration, it's baking in a $12 move. $12 move. So if we move more than expected, Apple would have to go down more than $12 or up more than $12. Okay. With this strategy, I mean, look at what my break even is. On the downside, we just have to get to 102.50. That's about $10. If we drop at least $10 or more, you're making money. Then on the upside, you basically got to go up about $10. I just need Apple to go up or down $10 or more in the next 3 weeks. So if you look at the chart, I think a good way of doing this is in the risk graph, you can set your slices to your break even. Set the slices to the break even. And then you can set that to your chart. And it will tell you this is the range that's being baked in for the next 3 weeks. So if you think that Apple can make its way above, 122, 123, or you think it can get below 101, 199, if you think it can get to either side of those red bars, then that would be you wanting to that would be in support of this strategy. Okay. In support of this strategy. Okay. Now, that is regardless of what implied volatility does. That is regardless of what implied volatility does. At expiration, if we are above 122, you will make a profit. Okay. If we're below 102 at expiration, you will make a profit. Okay. Now, implied volatility will probably drop a little bit after earnings, but what we're hoping is that there's enough of an upward move in price to where I make enough profit in delta to offset whatever I may have lost because I'm long volatility here, and vol's probably going to go down. Okay. The other tell though that maybe you're not going to get killed by a drop in implied volatility, the fact that they're only pricing in a $4 move going into earnings tells me that implied volatility is not super pumped, at least for the next couple of days. If implied volatility was super pumped going into earnings, they'd be pricing in more than a $4 move. So the minimal expected move is a reflection of the fact that they didn't really jack up implied volatility crazy high, at least for the options that expire in the next couple of days. Okay. So I don't mind a volatility crush if it's minimal. I also don't mind it if it can be accompanied by a big move in the stock. Okay. So that's how to think of the implied volatility. It's kind of a given that it's going to come down after earnings. The question is, will the stock move enough to offset the fact that you are going to be hurt by a drop in implied volatility? Okay. So how are you making money? Again, look at the risk graph. Okay. The stock is right here. If Apple goes up to 120, immediately I'm up $30. And by the way, this trade's cost me about $250. Paying $250 for a $5 wide debit condor. That means your risk is $250. You can make $250. So your risk reward's 1-to-1. Okay. But if it gets above, 120, 125, like that's where your max profit zone is. Okay. If it gets below 100, that's where your max profit zone is. So we're just hoping Apple makes a big move up or a big move down, one way or the other. Okay. And hopefully it keeps going. So if it gaps up, I want it to keep going up. If it gaps down, I want it to keep going down. I don't want it to come back to the current price. So pick a direction and move. Okay. Don't go up and then back down, or down and then back up. So that's where you'll have to decide. That's where you'll have to decide how much time or room you want to give it. If it runs up and then starts to come back down, what do you do? Or if it drops and then goes back up, how do you manage it? Quite honestly, if I'm putting on a $250 trade, even if you made $50 off of this, it's still a 20% return. Even if you bought the DebitCon for $250 and then sold it for $3, you still made a 20% return. So you don't have to hold this to expiration. If you get a big move and then the stock starts to revert back, you could always exit. So it's interesting because the trade starts out bi-directional, but it becomes a directional trade. This becomes a bullish trade, or it becomes a bearish trade once the stock picks a direction. So that's why you want it to continue to move in that direction. Okay. All right. Is $250 an expensive trade on a $111 stock? No. That's a really cheap trade. So when you come back to this long volatility discussion, remember, I said the debit condor is one of the cheaper bi-directional trades. Could you do a straddle? Yeah, you could do a straddle, Amit. It's more expensive though. So this DebitCon was $250. Had I done a November straddle, I would have bought the 110 call. Well, actually, we got a 111 strike. I'd buy the 111 call and I'd buy the 111 put. It's $11.50. So the DebitCon was $250. The long straddle was $1,163. So the long straddle is like 4 to 5 times more expensive than the debit con. You can still do it, right? But that's one of the differences. One of the differences is the long straddle is more expensive. Now, it would be interesting to see the break even on the straddle is 122.50 and 99. 122.50 and 99. Those are your break evens on the straddle. The debit con, based on the strikes I picked, the break even was 122 and 102.5. You could probably structure these where they have similar break evens. My debit con is skewed a little bit more. Well, my bear break even's closer than my bull break even. Straddle's a little more balanced on a break even perspective. But you can structure where they have similar break evens. It's just capital outlay. Do you want to put out 250 or do you want to put in 1163? Okay. Ilka, would the trade be more favorable if you do it a week earlier when the volatility is lower? It's a trade-off because the bull call and bear put might be a little bit cheaper with the lower vol, but you also have more time. So instead of buying a 23-day debit con, you're buying a 33-day debit con. So there's also more time that you're paying for. It would depend how much cheaper implied volatility was. Okay. In this case, I'm not really looking at this as a way to game the rise in implied volatility ahead of earnings. I'm more so looking at this as just a pure earnings trade in a situation where I judge they're not pricing in that much movement. So I want to bet it's going to move more than that. Okay. Microsoft would be a good kind of before, after. I'm pretty sure they weren't pricing in on a 10.5%, 5% move on Microsoft. I'd have to double check, but I would bet that if you did a debit con or a long straddle or strangle on Microsoft yesterday, I bet you're making money right now. I would bet Microsoft was not pricing in a 5% one-day move. So long volatility probably won on Microsoft, would be my guess. So if you get a similar type move with Apple tomorrow where it jumps, $5, $10, well, let's see. Well, I mean, more than $4. How about that? So Apple moves $5, $10, $15 tomorrow. You better believe the long volatility trade would have been the better play. Okay. If I were to short volatility into this, if you want to do it with more margin of error, you just go further out in time. Okay, you go further out in time. So, anytime you want to make it a little more conservative, instead of using a 1 week option, go out 3, 4, 5 weeks, right? Now, you go out and sell a 3-month strangle or straddle, it's not going to have that much sensitivity to earnings because you went out so far. So I think you're usually going to be playing within 1 week to maybe a month, maybe 2 months with these earnings trades. You get much further out than that, and it's kind of a blah trade. It doesn't really move much. Okay. How would I manage it if it goes against me? Well, here's the interesting thing. What does it mean to go against me? It means Apple doesn't move at all. So if Apple doesn't budge, or it goes up and then comes right back down, or goes down and then goes right back up, I don't want it to stay around 111. So what if it does? Well, then what's working against you is time decay and the volatility crush. So ultimately, I don't think you need to risk more than 50% at most of what you paid. So if Apple didn't budge, I paid $250 for the debit con, I'd probably risk no more than half of that. So as I advance time here, as we get closer and closer to expiration, you can see most of the loss is going to occur the last half of the trade. So you could say either A, I'm not going to risk more than half of what I paid, which is $125 in this case, So I'll give it as long as I can give it in hopes that it eventually does go up or down. Or you could look at it from a time perspective and you could say, well, most of the risk is in the back half of the trade because that's when time decay is the highest. I did a 20-day trade. I'll give it 10 days and then I'll bail, which I think would probably correspond to you losing about half of what you paid anyways. Okay. So exit halfway to expiration, or maybe exit when you lose half of what you paid. I don't think you need to risk much more than that myself. I think those are good two good rules of thumb. I think those are two good rules of thumb. Okay. Now I'm just curious, who had earnings? Did anybody important have earnings tonight? Any big names? I think it's all tomorrow. I was going to see if there was somebody I could use as a use case for this for today, because Microsoft's like, I've got to go to ThinkBack, but you could do the same exercise on any of the guys reporting tomorrow, Amazon and such. But as I'm looking at this, I don't know that there's any major guys tonight. Pinterest. All right, yeah, that's a decent name. Let's look at Pinterest real quick. Oh my gosh. Okay, Pinterest is up at $65. Pinterest is up at $65. How much was priced in? So Pinterest is up $15. They were pricing in about a $7 move. Okay, so for Pinterest, would it have been better to have been long volatility or short volatility? Long vol all the way, right? If you bought a straddle, bought a strangle, did a debit con, any one of those, you would have done quite well on Pinterest. So the market maker moves $7. You can see after hours, it's around 65. It closed at 49. So it's up $15, which is double the expected move. So if I did a debit con or any kind of bi-directional trade, Pinterest is a good example of one where you made out like a bandit if you were long volatility. If you were short volatility, if you did a condor or something that bet it was going to stay in a range or move less than expected, this is your worst nightmare because you're getting hosed. It moved way more than expected. Okay. Go Pinterest. Go Pinterest. All right, friends, I got to bounce. This has been fun. For those of you that want the notes, I'll give them to Mark. You can email team@tacotrading.com and get these if you'd like. If you enjoyed the session, smash the thumbs up button if you would. We always appreciate that. And I always appreciate you taking the time out of your day to join me. I hope that you found this helpful and informative as a guide for how to think about earnings, how to approach earnings, et cetera, et cetera. I will be on in 30 minutes for the Condor Mastermind group meeting. So for you cash flow condors out there, come join me for that here in about 30 minutes. For everybody else, come check us out. If you want a trial, team@tacotrading.com. You can check out the pro membership. Got plenty more where this came from. But as always, appreciate you guys for hanging out tonight.